Money. Money.
And I thought I would talk to all of my potential first-time home buyers and go over some mistakes so that you don't make these mistakes. The housing market is hot with the low interest rates and the lack of inventory. It is a great time to buy, but there is a sense of urgency to get out there and get a property while you can secure these low interest rates. Now, the first mistake is not understanding the comparison of rent versus mortgage. You might get frustrated out there as renters trying to get into your first home because of the lack of inventory, not getting your offer accepted. I encourage for you to stick with it and take a look at the numbers, because the numbers might motivate you in sticking with the process until you secure your home. The tax benefit, you need to talk with a licensed CPA or accountant, because I am not. I am a licensed mortgage professional, but I talk to clients about the benefit of home ownership all the time. And looking at the deduction that you have, you get to write off the interest and taxes on your property. So let's just say that was $2,000 a month. If you were in a 25% tax bracket, that would be $500 less in income taxes that you're paying. Now, a lot of first-time homebuyers don't realize that after consulting with your licensed CPA, you can find out how to amend your W-4 with your employer so you can see that benefit in your net paycheck every month. It's cash and it's real money. So either wait to the end of the year and paying less income taxes, or you make the adjustment so that you can see that money on a monthly basis. I don't know about you, but myself, I don't like the government collecting interest on my money, so I would definitely break even and see that in my net income and take-home pay. Now, homeownership as well, you've got the equity and by paying off the principal of your mortgage. So take a look at the actual principal and interest payment and see how much of that payment is actually going towards principal. What that is just money that's going in, equity into your home. So when you sell your home, whatever you've built up in that equity, plus is appreciation. Now, yes, we can't say where the market's going to go and what the appreciation is going to do, but previous guests that we've had in the show and the real estate experts and everything that's happening in our local market here with our employment opportunity and everybody coming into the market because of that employment benefit, I see that we're going to have appreciation continue for quite a while. But if you were looking, let's just say a 4% appreciation on a $400,000 property, that's 20 grand. To say 1% appreciation, that's $4,000. So you're building equity appreciation into your home, whereas rent, you're not making any money on that. Your money's not going towards anywhere except for a roof over your head for 30 days and then it's gone. Now, also just taking a look at a mortgage is it's fixed, so you know exactly where your mortgage payment's going to be. Unlike rent, if you're a renter, you know what I'm talking about because rents have increased quite high. If you just look at a 3 to 5% increase a year, whereas if you're on a mortgage payment, it's fixed. Principal and interest, if you're on a 30-year fixed rate mortgage, the only adjustment's going to be your taxes and insurance. Taxes will increase when your property increases in value. Taxes will decrease if the property drops in value. Now, also, you will pay that mortgage off. At some point in time, if you're on a 30-year fixed rate mortgage, you do have a payment end in sight, whereas rent, there's no payment end in sight. There are additional costs for homeownership, so looking at that in maintenance of the home, but you do have sweat equity, so all of that work that you're putting into the home, it's helping to build the appreciation in the property, whereas any additional work that you do on a rental property, no sweat equity for that. Homeownership, there is a commitment, so you want to make sure that you're looking at that. If you're not really sure what's going to be happening with your employment and you may not be staying in the area, you might want to reconsider your homeownership because there is a commitment of staying in that property at least for a couple years, so you've got enough equity that you've built to be able to sell and recover the cost of selling. Rent does give you a little bit more freedom. So if you're not really sure what you're going to be doing as far as your location, that's something that you do want to consider. Now, also, I would consider to look or not look at your home as an ATM machine because that is an area that caused some issues in the quick appreciation that we had last time before we had the adjustment in the market. So pulling money out of your property to do something smart with that, if you've got debt that you have that you're not getting a tax write-off on that and being able to pay that off for a lower interest rate, if you want to pull cash out because you're going to be increasing the value of your property, of remodeling the property, something to look at that time. Now, not being prepared to compete in this market is another mistake that you can make as a first-time home buyer. Quick decisions important. So you've got to be ready to go and understand what you're willing to do and what you're not willing to do to make your offer strong and competitive. There's a lot of waiving of contingencies, waiving your finance contingency, waiving appraisal contingencies. So you just really want to make sure that you're working with an expert real estate agent. If you need a reference and recommendation to that, I've got some of the best ones ones in our local market that represent right here in studio. So please call the show for that. Really important that you've got an agent that knows how to navigate through this process. Higher earnest money and knowing how to go in with earnest money can really help your offer. Again, that money is going to go directly towards the down payment. So it's money that it's going to go towards the loan when you're closing in the closing process. Now, put the cart before the horse. You want to make sure that you're getting pre-approved and you understand what your options are. There are a lot of different loan program options that are available. So analyzing those and making sure that you understand the options that are available to you is important. So getting that all taken care of prior to. Also understanding the difference in a calculation in the mortgage payment as you're increasing or lowering the amount that you're willing to go in for a property, because you need to decide exactly where you're comfortable in making that mortgage payment and then know where that limit's going to be so you can set that limit up. Also, when you've determined what that maximum payment is that you want to make on a monthly basis, make sure that you're understanding what you need to increase in your value, because just because the property is listed for $400,000, most likely you're not going to be paying for $400,000 for that property. So you've got to make sure that you put that in the calculations when you're actually looking at properties online. Make sure that you're prepared, obviously, for the cash that you're going to need and the options that you have available for there. Inspection, your home inspection. Don't skip it. You're probably going to have to waive the home inspection to be competitive anywhere in our local market, but going in and doing a pre-inspection is going to be important. About 10% of recent home buyers that didn't have inspections, according to the American Society of Home Inspectors, these buyers were trying to cut the cost, foregoing the fee that the inspection charged to perform a 2 to 4 home search to flag materials defects of the property. But those defects can result in thousands of dollars in damage down the road. Inspection rates start maybe at $450 on an average, and depends obviously on the home size and the age of the home, but is it worth it to save $450 not knowing what's going on with that home? And not just that, but I've had great inspection representation in studio before. If you've listened to previous shows, it's really about the home, and where it's going in the future is important as well. So you know what areas of things could become a problem and what you need to do to prevent for that being a costly issue for you down the road. So there's just some advice for my first-time home buyers out there. Make sure you're prepared, get into the market, stick with it. Great opportunity to buy a home. And coming up next on the Money Hour, common entrepreneurial mistakes and how to avoid them. Dan Wingard with Super University right here on 1150 AM KKNW after the short break.